Why are all countries in debt, and who do they owe? If you hear that a country is in debt, it sounds like something has gone terribly wrong. After all, when a person is deeply in debt, it usually means they're struggling to pay their bills. So how is it possible that almost every country on Earth is in debt, even the richest ones? And who are they actually paying all that money to? Imagine an alien looking down at Earth's finances like a giant balance sheet. It would see that governments owe about $100 trillion. Now compare that to everything the world produces in a year. All the food, cars, houses, and services across the planet. In total, everything the world produces comes to about $123 trillion, which economists call global GDP. So the alien would notice something strange. The world owes almost as much money as it produces in an entire year. So how did the world end up like this? To answer that, we need to start with a simple question. What exactly is this debt every country has? What national debt really is? Think of national debt as the balance on the government's credit card. It collects taxes from workers and businesses. Then it spends that money on schools, hospitals, roads, pensions, the military. If it spends more than it collects, it has a gap. That gap is called a deficit. And when deficits keep happening year after year, they pile up. That pile becomes the national debt. It's like a household earning $4,000 a month, but spending $4,500. Every month, it borrows $500. And over time, that turns into a big debt. Countries work the same way, just with much bigger numbers. And when they get it wrong, entire economies can collapse. So the real mystery isn't why countries borrow. It's why the whole system hasn't fallen apart yet. The answer lies in how governments actually borrow money. How governments borrow money. Governments don't walk into a bank to borrow money. Instead, they use a system that quietly turned government debt into the safest investment on Earth. And they do this by selling something called government bonds. A government bond is like a receipt that says, you gave the government $1,000 and it promises to pay you back later. It means someone gives the government money today, the government promises to pay it back in the future, and the government pays a little extra each year as interest to that person. Here's what that looks like in one example. The government needs $1 billion. So it creates 1 million bonds, each worth $1,000. Banks, pension funds, and regular people buy those bonds. Each time someone buys a bond, they are lending $1,000 to the government. So the government collects the $1 billion it needs. In return, the government promises to pay interest, say 3%. That means each bond pays $30 a year to the person who bought it. After 10 years, the government returns the original $1,000 to each lender. And that's how countries borrow trillions of dollars without ever going to a bank. And here's the surprising part. The safest place in the world to store money is literally a government IOU. The entire financial system runs on those promises. And if people ever stopped believing them, the consequences would spread everywhere. And if investors ever stop trusting those IOUs, the whole system starts to shake. And there's one detail most people never hear about, and that is bonds are transferable. If someone buys a government bond, they don't have to keep it. For example, a pension fund buys a government bond. Later, it sells that bond to a bank. Now the bank owns the IOU instead. The government still owes the same money, but the person holding the IOU has changed. But for most of history, this system didn't exist at all. A few hundred years ago, lending money to a government was incredibly dangerous. History of government debt. Before the 1900s, government debt was very simple and very risky. Imagine a king who needs money for a war. He doesn't go to a market or sell bonds. He sends a messenger to a rich banker and asks for a huge loan. The banker hands over chests of gold. Now the banker has only two possible endings. The king pays the gold back later, or the king refuses and keeps the gold. There are no contracts anyone can enforce. No courts. No markets to sell the loan to someone else. It's like giving your life savings to a ruler and just hoping he feels honest. Then the 1900s arrived, and the scale of government spending exploded. During the World Wars, countries needed mountains of money. They had to build tanks, ships, rifles, planes, and pay millions of soldiers. So instead of asking one banker, governments started selling bonds to everyone. Posters went up in cities. Banks sold war bonds at their counters. Families used their savings to lend money to the government. Now, the government wasn't borrowing from one person. It was borrowing from millions. And that change made debt much safer. But it also made it much easier for governments to borrow too much. Now, instead of depending on one rich banker, governments could borrow from millions of ordinary people. And no, government bonds weren't invented by the Illuminati in some secret underground meeting. They were simply a practical way for governments to borrow small amounts from lots of ordinary people. But there was still a problem. What if people stopped buying the bonds? What if the government needed more money than investors were willing to lend? The war couldn't just pause. Soldiers still needed food. Factories still needed steel. Ships still needed fuel. So governments needed a backup plan, and that's why central banks stepped in. They became a buyer that never ran out of cash. If the government issued bonds and no one else bought them, the central bank would step in and buy them itself. It was like the government walking into a shop and saying, "I need to sell these IOUs." And the central bank replying, "I'll take all of them." To pay for those bonds, the central bank simply created new money. This meant the government could always find a buyer for its debt, even in the middle of a crisis. The crazy part is that idea never really went away. Today, when economies slow down, central banks still create money and buy government bonds to keep borrowing cheap and the financial system running. Now, governments could always find someone to buy their bonds, so borrowing became much easier. What happens when debt gets too high? But what happens when investors stop believing the government can pay them back? Well, the investors demand higher interest rates or stop lending to the government altogether. At that point, the country usually faces a crisis. This has happened many times in modern history. And when it does, the effects can be immediate. For example, for years, Sri Lanka borrowed heavily, often in foreign currencies, to pay for projects and government spending. This meant the country had to repay its debts in dollars, not its own currency. When tourism collapsed, Sri Lanka stopped earning many dollars from foreign visitors. But it still needed dollars to buy fuel, food, and medicine from other countries. As global prices rose, it had to spend even more. Soon, the country ran out of dollars, so it couldn't pay for imports, which are goods bought from other countries like fuel, food, and medicine, and it couldn't repay its lenders. In 2022, the country defaulted. The effects were immediate and visible, mainly because Sri Lanka depended on imports for essential goods. Fuel stations ran dry because the government of Sri Lanka had no dollars to buy fuel from other countries. Power cuts lasted many hours because many power plants relied on imported fuel the country could no longer afford. Food and medicine became scarce because Sri Lanka could not pay for enough imports. Protests spread as daily life became more difficult, and the president eventually fled the country. Sri Lanka eventually got help from the IMF, a global lender of last resort for struggling countries. It lent Sri Lanka money in exchange for spending cuts and tax increases. The economy stabilized, but many families were left struggling with higher prices and lower incomes. So could something like this happen to a rich country? The same kind of crisis could one day happen to the United States, but it probably wouldn't look like a sudden collapse. Because the US borrows in its own currency, and because the dollar is the world's main reserve currency, the currency most countries use for global trade and savings, investors still treat US government debt as one of the safest places to park their money. But if the debt keeps rising, more and more tax money goes just to interest payments. Less for schools, less for roads, less for healthcare. One way to picture this is like plaque building up in the arteries of a heart. At first, nothing seems wrong. Life goes on normally. But year after year, the blockage grows, until one day, it triggers a heart attack. If that ever happened, the US would have to cut spending, raise taxes, or print more money just to keep up with interest payments. It wouldn't collapse overnight. But the US could slowly become more like a middle-income country, still functioning but far less dominant and prosperous than before. So if countries are borrowing all this money, who are they actually borrowing it from? Who holds government debt? So who are governments actually in debt to? You might imagine one country only owing money to another. But the truth is more complicated than that. There are three main groups that hold government debt. First, people and institutions inside the country. This is the biggest group. It includes regular people saving for retirement, banks, pension funds, insurance companies, and investment funds. Here's what that looks like in real life. A worker puts money into a pension fund. The pension fund buys government bonds. The government pays interest on those bonds. That interest eventually helps pay the worker's retirement. So in a very real sense, the government is paying interest back to its own citizens. The same thing happens with banks. When you deposit money into a bank, the bank doesn't just leave it sitting there. The bank invests some of that money in safe assets, like government bonds. So part of your savings account may actually be lent to the government. Second, the central bank. This buyer is very different. A normal investor uses existing money to buy bonds, but a central bank can create new money. During crises or recessions, the central bank may buy huge amounts of government bonds. Imagine the bond market as a shop. Investors stop buying. The shelves are full of unsold IOUs. Then the central bank walks in and says, "I'll take all of them." It pays for those bonds with newly created money. Now here's the important part. When the central bank starts buying huge amounts of bonds, demand for bonds rises. And when demand rises, the price of those bonds goes up. But the payment from the bond does not change. For example, a $1,000 bond paying $30 a year gives you a 3% return. But if heavy buying pushes the bond's price up to $1,500, you still only receive $30 a year in interest. Now your return is only about 2%. The payment stayed the same, only the price changed. And that's what pushes the interest rate down. So when central banks buy bonds, bond prices go up, interest rates go down. And when government interest rates fall, mortgages get cheaper, car loans get cheaper, business loans get cheaper. So the central bank isn't buying bonds just to earn profit. It's doing it to keep the whole economy running smoothly. That power can keep an economy alive in a crisis, but overused, it can quietly destroy the value of a currency. Third, foreign investors and governments. The last group lives outside the country. These are foreign governments, global investment funds, overseas banks, and international investors. They buy government bonds as safe places to store money. For example, a foreign country might sell goods to the United States and receive dollars. Instead of leaving those dollars in a bank doing nothing, they use them to buy US government bonds and earn interest. But this creates a risk. If too much of a country's debt is held by foreigners, and those investors suddenly lose trust, they can stop lending or pull their money out. That's how countries suddenly run out of money, like Sri Lanka did. In rich countries, most debt is held inside the country. But in poor countries, a much larger share is owed to foreign lenders, which makes them far more fragile. And that's why debt-free sounds good, until you see what it forces a normal country to do. Are there any debt-free countries? Almost every country on Earth has some government debt. But a few unusual countries manage to keep it extremely low, and they all have something special in common. So, what's their secret? Take the country Brunei. It sits on huge oil and gas reserves. The government earns so much money from energy exports that it can pay its bills without borrowing much. It's like a household that owns a profitable oil well in the backyard. There's less need for loans. Palau is different. It's a small island country, but it has a special deal with the United States. In exchange for allowing the US certain defense rights, Palau receives major financial support. So instead of borrowing heavily, part of its budget is covered by outside help. And then there's Niue, one of the closest examples to a debt-free country. Niue is a tiny Pacific island with only about 1,500 people. It relies heavily on financial support from New Zealand. Because the population is so small and much of the budget comes from aid, the government simply doesn't need to borrow much money at all. But countries like these are the exception. Most nations don't have giant oil reserves, huge savings funds, or wealthy partners paying part of their bills. They still need to build roads, run hospitals, pay teachers, and handle emergencies. So what would happen if a typical country tried to run with no debt at all? Well, if they refused to borrow money, they would usually face tough and unpopular choices, like sharply raising taxes or cutting public services. So when you hear that a country has debt, it doesn't automatically mean something is wrong. In modern economies, borrowing is normal. The real danger isn't having debt. It's losing control of it. Thank you for watching and subscribe for more videos like this.